On the surface, last week looked like a dream for Wall Street. Stocks soaring, records in sight, champagne corks flying. But here's the twist. While the US was celebrating, the rest of the world was facing a very different reality. And if you missed that part of the story, you could be setting yourself up for a nasty surprise. So why are US markets partying while Europe and Asia are flashing warning signs? And what could flip this entire rally on its head? That's exactly what we're breaking down in this video. Stick around because the next few minutes could completely change how you see the global economy. Don't miss out. Hit like, share this with a friend, and subscribe right now. And whatever you do, watch the full video now before the markets move again.
Okay, so at first glance, last week looked absolutely phenomenal for the markets. You had US investors celebrating what seemed like purely good news. But here's the thing. If you zoomed out, you'd see the party wasn't exactly global. In fact, for a big chunk of the world, a very different story was unfolding.
I mean, just look at the S&P 500, which is a huge barometer for the U.S. economy, right? It surged by more than 1.2%, and it's marching right back toward record highs.
And the tech-heavy Nasdaq? It did even better, soaring past 2%. So yeah, on the surface, it really was a fantastic week for Wall Street.
But that brings us to the big question, doesn't it? While the U.S. markets were basically popping champagne, was the rest of the world sharing along with them? Well, the answer reveals a global economy that's far from united right now.
So what kicked this all off? You can thank the U.S. Federal Reserve. In a huge policy shift, one that investors had been waiting on for months, the Fed finally cut its benchmark interest rates for the first time this year. It's a massive signal that maybe, just maybe, the good times are coming back for stocks.
Now, this kind of shift has a name. It's a dovish pivot. Think of hawkish as when a central bank is aggressive, raising rates. Dovish is the opposite. It's like the Fed is taking its foot off the economic brake and gently pressing the accelerator. And for stocks, that is usually fantastic news.
And, you know, this optimism wasn't just about the big tech giants. This is really key. The Russell 2000, which tracks smaller companies, was also a top performer. That's a huge sign of broad-based confidence across the entire U.S. economy.
However, if you look just a little bit closer at the U.S. data, the picture starts to get, well, a little messy. The foundation of this big rally might not be as solid as it seems.
And this is where things get tricky. On one hand, retail sales were surprisingly strong, so the American consumer is still out there spending. But then you look closer. Housing starts slumped, badly. And the 10-year Treasury yield, which is a really key indicator for long-term inflation fears, it actually rose. It's a very mixed bag of signals. That mixed bag in the U.S. becomes a world of starkly different realities the second you zoom out. The Fed's rate cut landed in a global economy that is definitely not on the same page. This quote from our source material just nails the tension perfectly. While Wall Street cheered, Europe grappled with stubborn inflation and Japan inched closer to monetary normalization. I mean, that says it all. One country's celebration is another's caution. So let's break down exactly what that means. All right, first stop, Europe. And yeah, there was no big party happening there. Instead, the mood was much more cautious, with markets mostly flat, as the region deals with its own unique set of problems. You see a few little glimmers of hope, like a small rebound in industrial production. But then you have the Bank of England holding rates steady to fight inflation, and UK payrolls have now fallen for the 7th straight month. The big takeaway here? Europe's economy is fragile and pretty much just treading water.
Okay, now let's hop over to Asia, because this is where the divergence gets even more dramatic. We're looking at a tale of two economic giants, Japan and China, and they are heading in completely opposite directions.
On one side, you have Japan, where inflation is proving to be super sticky, and the central bank is actually talking about raising rates. And then on the other side, there's China, where growth is sputtering, the housing market is in trouble, and everyone is just waiting for the government to step in with more stimulus. It's like they're living in two completely different worlds.
So, with all these different paths being carved out, what should we be watching for next week? Let's look at the 5 key risks that are on every investor's radar.
Globally, investors are keeping a close eye on 5 interconnected areas. There's the risk of U.S. inflation picking up again, more cracks in the U.S. housing market, weak confidence over in Europe, a potential delay in stimulus from China, and a possible policy misstep from the Bank of Japan. Any one of these could change the whole narrative.
For instance, a hot inflation report in the U.S. could completely undo those rate cut bets.
In Europe, more weak data could really heighten fears of stagflation. That's that nasty mix of slow growth and high inflation. Meanwhile, if China doesn't act, that could sour the mood everywhere, and a surprise move from Japan could spark major currency volatility. Each of these has serious ripple effects.
So, after looking at all of this data from around the world, the one clear takeaway is this: the idea of a perfectly synchronized global economy is, at least for now, a myth. The world is just not moving together.
And that leaves us with one final critical question to think about. We live in a deeply interconnected world. So how long can major economies continue to walk down such different paths before something has to give?
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.